Historical data shows that one single specific investment has never lost money over any 20-year period in history. Within the next 15 minutes, we are going to bypass the standard financial confusion and put your money into a system that grows entirely on autopilot. This process requires no stock picking experience, no daily monitoring, and no specialized background, just a bank account and a few dollars to start. Building long-term wealth is less about complex financial intelligence and more about accessing the right automated system as early as possible. To understand how this works, we start with the S&P 500. S&P stands for Standard & Poor's. It's a list of the 500 largest U.S. companies bundled into one investment. By owning a fraction of all 500, you create a safety mechanism. If one fails, the impact is minimal because 499 others keep growing. These are the heavyweights that run the American economy, companies like Apple and Microsoft. Buying the S&P 500 is a way to bet on the long-term growth of the entire U.S. economy, rather than gambling on the success of a single business. Most beginners freeze when they see thousands of different stocks and funds available on the market. If you use Fidelity as your brokerage, buy the fund with the ticker FXAIX. It has an expense ratio of 0%. Meaning you pay no fees to hold it. If you use Vanguard, search for VU. It is one of the most trusted funds in the world, with a near-zero cost of 0.03%. For those on apps like Robinhood, you can also use VU or a highly liquid alternative called SPY. All three of these tickers track the exact same 500 companies. The choice is simply about which platform you prefer to use. First, open your brokerage account, link your checking account, and transfer your initial funds, even if it is just $50 or $100. Once the money arrives, use the search bar to find your specific ticker, like FXAIX or VO, making sure to select the exact match. Click Buy, enter the dollar amount you want to invest, and finalize the order. Finally, go to your settings and turn on Auto Invest. Set a recurring amount to be pulled from your bank every month, so the process happens without you thinking about it. Completing these steps removes the friction of manual work and emotional decision-making, placing your financial future on a consistent, automated trajectory. Once the system is running, the main objective is to avoid common mistakes. When the market inevitably drops 20%, many beginners panic and sell their shares. You should view these drops as a discount. Your favorite companies are suddenly 20% cheaper, which makes it the best time to buy more. Avoid the habit of checking your balance every day. Constant monitoring creates anxiety that often leads to impulsive, expensive errors. Do not wait for a perfect economic moment to start. Every day spent waiting is a day of compound interest you are missing out on. Volatility is a natural part of the market cycle, but impulsive reactions to that volatility often cause more damage to a portfolio than the price drops themselves. By setting up this system, you are now a long-term investor, insulated from daily market noise. To see why starting immediately is the most important factor, consider Person A and Person B. Person A invests $200 a month starting at age 22 and stops at 32, putting in $24,000 total. Person B starts at 32 and continues until 62, investing $72,000, 3 times as much as Person A. By age 62, Person A has $1.2 million. Person B has only $500,000. Person A ended up with more than double the wealth because they gave compound interest an extra decade to work. Take action today. If this guide helped you, subscribe for more tips and let me know in the comments if you are starting your investment journey right now. In wealth building, the specific dollar amount you invest matters far less than the total number of years you allow that money to compound.